So Schroders is a global asset manager. We've been around for over 200 years globally, and we've been operating in Australia for over 50 years. We run a range of strategies across the world and now a range of diverse strategies within the Australian market. Most importantly though about Schroders is that we're an independent and active, predominantly active fund manager. So it's really critical that we're not owned by a bank, we're not owned by an insurer, we're still majority family and staff owned. And that means that ultimately our profitability, our success lives and breathes on the returns that we deliver to our clients. So it's a very important part of that independence and active belief that we have. Now in Australia, predominantly we're known as being an Australian equity manager. We've been doing that. We've got the longest running Australian equity fund. It's been running for over 50 years. But we run a range of strategies within Australia. So not only the Australian equity capability that we'll talk about today, but also fixed income. Half our global equity team sits in Sydney, as well as broad multi-asset franchise. And the reason I mention that is that it's important because that gives us perspective. A lot of managers now have been driven down a route of specialisation. And so if you're only operating in a very small asset class or a very small unit, often it's very hard to gain perspective of what's going on around the world. And so some of the conviction that we have in our portfolios comes from the fact that we have a fixed income team as well as an equity team, by way of an example. Now in Australian equities, we run around $10 billion in Australian equities, and there are two key strategies that we run. One is the Schroder Australian Equity Fund, which we're talking about today, which is the fund that we're most well known for. But we also run another benchmark agnostic strategy within the team as well. And that team is a large team. It's a team of 14 investment professionals. So we've got a very large investment team, really focused on the Australian share market. So similar to a lot of investment managers, there's obviously a base compensation package of base salary plus a cash component, but it's very important that we have alignment of interest between the investment team and the strategies. And so a large part, or the majority of most of the investment team's compensation is invested into the strategies in which we invest. And that's the same around the Schroders franchise, and so the individual investment teams are remunerated in line with their strategies. Look, the objective of the strategy is to outperform the Australian share market over the medium term. Now, as I said at the start, we've got an enviable track record, a very long track record, where we've been able to deliver between 200 and 300 over the market, and typically with less risk than the market. Now, we are asking for a medium-term time frame. That's one of our core beliefs. So there is short-term volatility in the numbers, but over the long term, we've been able to deliver significant alpha over the market with less risk than the market. Look, the starting point for the investment philosophy is that we believe that markets are inefficient, and also that we believe in diversification. And so taking that one step further, what we're looking for is we're trying to find high quality businesses that can deliver a return on capital greater than their cost of capital consistently through time, or a business where we can see that trend improving. If we can do that consistently through time, we can find better quality businesses through time, we believe that will deliver alpha to our clients over and above what is typically a market cap type weighted market index. Now, importantly in that's one side of the equation. The other side of the equation is how we think about risk, and that's a key differentiator for Schroders. So we think about risk in a fundamental way, in a forward-looking way, just like we do in terms of our valuation forecasts, rather than thinking about risk in terms of volatility or tracking errors or standard deviations like a lot of the market do. So it's a really important part. There's two prongs to our beliefs and our philosophy and the way that we're building portfolios, and each of those are just as important when we're trying to put a portfolio together. One of the key things about the way that we think about the market is that we cover every stock in the market. There's a very important piece. We're not just looking at a part or a section of the market. And I often talk about we have more research on companies that we don't own often than the companies that we do. And so it's a really important point. So when we see markets change, we can react to those changes in the market. Now, in terms of research, we kind of separate it. So the stock research is very importantly sits with the analyst. So the analyst builds a model, and then the team discusses the inputs to that model. That's a really important point, and that is then separate from the portfolio construction decision, how we think about it. Now, in terms of how do we pick stocks, in simplistic sense, our philosophy is thinking about the quality of the industry that a company operates in, the quality of the business that we're looking at, and then, which is a Porter type framework, and then our view of what that business is worth in mid-cycle. So we talk about mid-cycle valuations in terms of how we think about valuing the company. And so that's what we're trying to do. We're trying to exploit short-term inefficiencies in the market with a long-term perspective. Now, once we then move to the portfolio construction part of the process, that's really just about building the portfolio and building a diverse portfolio of ideas, but we're separating the research piece with the portfolio construction piece. We certainly believe that it doesn't make sense for a portfolio manager just to walk away and build a completely separate portfolio that's independent of the analyst ideas. So it is very much integrated in terms of how we think about building the portfolio from those ideas that are generated from the research. Look, the reality is we aim to be fully invested. We believe our clients are making that asset allocation decision. Our job is to be fully invested, not to be running to cash at various different points. So the reality is, what's the key risk in the fund? The key risk is equity market risk. Right? If we see risk in markets, that's the key risk that investors are exposed to. Now, when we then put that into the context of the market that we sit in, we would much rather have the portfolio being driven by stock-specific risk. And that's certainly how we think about the portfolio in terms of putting a diverse portfolio of ideas together. But then the reality is that we sit in a global market. And so with a market that is very heavily exposed to resources, to banks, financials, the other key macro risks are China, are the Fed. What Yellen's doing with rates is a key driver to equity market risk. So we have to be very, very cognizant, and unfortunately a lot of time needs to be spent thinking about those large macro drivers which can drive markets for a long time. We've been through a phase of quantitative easing for the last 10 years that's been driving markets in one way. And so we need to be very cognizant of the impact that that has on markets and then the underlying stocks that we're buying. But fundamentally, we're trying to buy cheap companies, we're trying to buy high quality companies that we believe are going to outperform the market. So at a portfolio level, rather than thinking about volatility or the risk of, or the volatility of earnings of a company, we think very much about the fundamental risk that a company is exposed to. Now we look at 26 fundamental risk factors. They're all forward-looking risk factors, but they're predominantly driven by, or the thinking that we have is, what is the risk that we're wrong, right? So we have a view about valuation, but then it will be a range of outcomes. That's the reality of investment management. Even the best fund managers are wrong 40% of the time. There will be a range of outcomes around that. So our risk framework is really about what is the risk to our valuation being wrong. Now, how can you be wrong? Well, typically the major drivers, and I say that there's a range of them that we're exposed to, but the major drivers are financial leverage and operating leverage. You know, you think about an airline typically has massive financial leverage and very high operating leverage. So if you're on the wrong side of that, you can be very wrong for a very long period of time. And so what we do with that thinking is that we'll control that risk through position size. If we're investing into a low risk business, then we're happier to take a larger position. If we're investing into a higher risk business, then we'll control that through position size in the portfolio process. Look, the aim of the strategy is to give our clients a return that is better than the market over the medium term. And so we do need to be cognizant of how the market is positioned. And so we are taking positions relative to the market. In reality, how does that play out? We will take a stock position to a plus or minus 5% position. And that's really pretty much the only limit that we have within the strategy. Now, to put that in context, at the height of the mining boom, we were 10% underweight resources. So we were taking significant risk or tracking difference to the market. More recently, as resources have sold off, we've taken a significant overweight into resources, and we were 10% overweight resources. So you can see that we are very willing to take significant risk into the portfolio when we feel it's appropriate. Now let's put that in context though. At the height of the mining boom, when we were underweight, we owned more resources in the portfolio at an absolute level than we did at the low when we were overweight. And so one of the things that we have to be very cognizant of is the market itself. We operate in a very highly concentrated market where our market is dominated by banks and typically resource companies. And so one of the things that we're trying to deliver to our investors is a better diversified portfolio. And so that's one of the things that we're trying to build into the portfolio construction process, is to build diversity of factor risk, so to speak, diversity of the bets that we've got on in the portfolio, rather than loading the portfolio on one thematic, which we can see often play out in concentrated portfolios that we compete against in the market. Look, we ask clients to give us a market cycle. A market cycle is typically 3 to 5 years. But the reality of cycles is that they can last for a much longer period than that. Now, depending on the environment that we're in, they can last, like we've been in a market cycle for the last 8 years, we would argue. It's been stimulated by quantitative easing. We've got a lot of artificial stimulus out there, a lot of debt in the world, and we've been in a very long period. Now, put that in context of how we think about investing. Our valuation, our view of businesses is typically very stable. Our valuations are very stable through time. And if something fundamentally changes with a business, our view of that business doesn't normally change. We're not short-term investors, we're very much long-term investors. And so what happens is it's the market, it's the share prices that move around us. And so part of what we're trying to do, and the discipline behind the process, is to exploit those short-term inefficiencies in share prices and have that longer-term view. Typically, that's 3 to 5 years where we can exploit those inefficiencies in markets, but sometimes that can last a bit longer. But that's part of the process of what we're trying to do.